then I realized that, over the years that I had owned, many of these houses and apartments, it was still susceptible to the economy, susceptible to people destroying your property, not paying rent, or at least that's what the courts called it. I call it stealing and destroying property. And I just realized there's got to be a better business model, and began looking into self-storage. And sure enough, it was. I saw the light, sold all my houses, apartments, went 100% into self-storage, and I haven't looked back.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman in sunny Florida.
Sunny with rain.
Sunny with rain. Yeah, we had a lot of rain.
A lot of rain.
So like hurricane. I mean, hurricane season started early this year. So we've trying to swim through, particularly in the Tampa Bay area, just swim through the marshes here to get back and forth from home. But that's Florida. That's what we live here for. We love it. And you're actually traveling across the state this week because you're going to a conference, which I always like when you leave.
That's right. It's a lot quieter, right?
There's a lot of peace and quiet. We don't have to worry about the constant interruptions.
I was thinking the same thing about my drive there.
Yeah, of course. But it's not just me you have to worry about on your drive. So, we had an episode or an issue that came up this week. It's not just this week. It's ongoing. But when you're a property owner and you own one property, whether that be a 40,000 foot, 100,000 foot retail center, or that be a quadruplex, you're probably not going to see higher insurance rates than you see at that one time. And Stephen, why don't you explain to people why that is? You own one property. Why are you paying higher rates?
Sure, you got one property. You're a risk assessment. So you go in and they're evaluating just that property. If you can find a way to have more properties and spread the risk.
Yeah, but not everybody's got that opportunity to buy multiple properties, Stevens. I mean, this is part of the issue, right? I mean, if you're an owner of a 100,000 square foot retail center, maybe you don't have the capacity to go out and buy, but you are paying high rates. I mean, it is what it is. Yeah.
For sure. We've seen that just from the properties we manage.
No doubt. And when we see the investors that own multiple properties, you certainly see per square footage of that insurance go down, particularly if it's spread across geographic areas as well. And the more properties they own, the larger the geographic spread, the more we see these insurance rates go down. So volume is one of the keys, and diversifying risk is one of the keys for the insurance company to be able to lower premiums, because obviously, if you've just got one, that's what you're exposed to. But, we're talking to a guy right now in Manatee he owns one plaza, and that's probably one of the keys that we can talk to him about and help him lower his insurance costs on that plaza, because he's going to be moving his insurance into our pool. And that's, referred to as a master program. And he would be treated in the same way because we manage the master pool and have all of our properties under one umbrella, because we are doing the management for those centers. And he's able to be treated as if he owns multiple centers. That's a little bit unusual.
Well, he gets the benefit of
it. Yeah. And I mean, it's something that was an eye opener for him. It was a fairly substantive cost savings for him. So we're looking to onboard him on the property management side in the next couple of weeks here, and trying to work out some of the final details with him. But that's these onboarding sessions can be beneficial for the owner. It can be exciting for everybody involved. Certainly, there's a heck of a lot of pressure, Stephen, because it ends up for about a month that we're running around like a chicken with our head chopped off and getting all of the vendors and the checks and the insurances and everything lined up.
And the loss runs and everything.
And all the things that entail in making sure we understand the property backwards and forwards. So we're going to be pretty busy when this guy comes on, which it sounds like he's going to do. Stephen, we've got a great guest today. We've not talked about self-storage here in a long time, and we have a guy who's pretty darn experienced in that arena. Is there anything you want to sort of talk about before we get rolling in with our guest?
We got a lot to listen to, and talk to, so I'm ready to rock and roll.
Okay, well, let's get going.
Today we have with us Scott Meyers. Scott is a leading expert in self-storage. His companies focus on syndicating self-storage, and he also has his own self-storage business. He is the principal in 16 facilities, totaling over 5,000 units and approximately 1 million square feet of storage space. Scott is the founder and president of selfstorageinvesting.com, a self-storage education company. His company was started in 2006 for the purpose of acquiring, developing, and operating self-storage facilities, and he has raised over $20 million in syndicates and private equity partnerships. Scott, welcome to the Invest Florida show.
Well, thanks for having me. I appreciate the time to be here to talk about my favorite topic.
Well, Scott, we definitely appreciate you investing time with us. People usually don't get into investing and jump right into self-storage. So can you give us somewhat of a background of how you arrived where you are today in the self-storage world?
Yeah, you're absolutely right, Eric. And then I got into the business by way of being fed up and frustrated with the tenants and toilets. Probably the best way of putting it. Like many people, I got into the real estate business by buying single-family houses, and we were renting them out. And then wasn't seeing the returns that I wanted, the cash flow, as well as the free time that all the gurus had talked about and all the home study systems that I bought. So I decided to ramp things up and get into apartments, thinking economies of scale would fix it. So we had 80 houses, 400 apartments. And then the tech bubble burst in 1999, which caused the administration, the presidential administration at the time, to offer up via the Community Reinvestment Act these loans backed by the government where anybody who could fog a mirror could buy a house. And so all of our tenants left, and they did. And who can blame them? So we were left with some shortfalls, turned that business around, trying to sell them off as much as possible, and made out okay, basically about a break even right before we almost went bankrupt in the process. But then I realized that, over the years that I had owned, many of these houses and apartments, it was still susceptible to the economy, susceptible to people destroying your property, not paying rent, or at least that's what the courts called it. I call it stealing and destroying property. And I just realized there's got to be a better business model, and began looking into self-storage. And sure enough, it was. It's recession proof because when the economy tanks, people downsize and businesses downsize, and storage actually benefits better than most industries during a recession. And when times are good, people store more things. And when people don't pay you, you lock them out and you sell their stuff, which is unlike anything that we can do in the habitational real estate world, or the world of tenants and toilets, where eviction laws protect them. So I saw the light, sold all my houses, apartments, went 100% into self-storage, and I haven't looked back.
When was your first purchase?
So my first purchase was in 2006. It was a partnership that I purchased a facility, and we purchased a 392-unit facility not too far from home here, and went in as 50-50 partners on the note and down payment. I had a $10,000 a month positive cash flow the day we took over, and it continued to rise from there. And I thought, yeah, this is a pretty good gig. And then I went out on my own after that partnership and began buying them up myself.
And that stayed pretty stable during the recession?
It does. As a matter of fact, the industry statistics show, are actually across all industries, if you look at a recession, the only other sector of our economy that does better than self-storage during a recession is, can you guess?
Bankruptcy lawyers.
Good one. And very close, but no, it's alcohol. It's liquor. That's
alcohol.
The only one. And nobody can afford a vacation, but they always can afford a mini vacation by buying a six-pack. So it does better during a recession than any other area of our economy. And self-storage is number 2. It's right behind it. So yeah, it's absolutely. We are waiting for the next recession with bated breath right now. We obviously can't wait. It's going to be. Once again, an opportunity for us to continue to fill up and raise rates, but also we have a war chest of cash and equity behind us to buy and develop more facilities, and we're getting ready.
Give us a little bit of a background of where the market is now? There's been so much change in self-storage and you said you're getting ready. What is your feeling on where the market's headed?
Yeah, and no doubt. I mean, 2006, when you bought your first unit, the business has changed. And also there's been shift in ownership and who owns and how owns, and the large players have gotten into the market, the REITs, the self-storage REIT and those sorts of folks. So to kind of give us a 30,000 foot overview of what the profile of the market looks like right now and where it's going and how it's changed.
When I got into the business, I was investing for a few years, and I was one of the few people that was actually teaching on it as well in my local real estate investor association. And then I began asked to go out and speak at the industry trade shows and then at some real estate investment groups on it, and where there was really nobody talking about it. And apparently everybody, more people than I have the ability to touch have heard my words, or finally self-storage got the attention that it deserves. And so you're right, Eric. We've gone through an incredible change. So what was the stepchild of the commercial real estate industry, all of a sudden, when you begin to look at it, like I did back in 2005 and 6, I was so naive to think that, okay, I'm stepping up the commercial real estate ladder by buying apartments, and then I'm going to get into Class A apartments, and then eventually maybe office buildings, or who knows, maybe golf courses or marinas. But what I overlooked is that these 10 by 10 metal boxes or sheds on concrete slabs, these were the most profitable. This was the most profitable sector of the commercial real estate asset classes, bar none. And it had been for the past 30 years. And it's been right under my nose and under all our noses, but it was just, it's not sexy enough. And so nobody looked into it. Well, I realized pretty quickly when I almost went bankrupt in the tenant toilet world that, cash flow is sexy. So I began to look into it a little bit further, and so did other folks as well. So, and we kind of, the progression we took is really right in step with where the industry was heading. So we were buying existing facilities from mom and pops. We would implement technology anywhere that we possibly could, from not only the property management side of the business, but adding these kiosks and replacing a lot of the manager's hours, adding security, adding access via your phones, having responsive websites that are mobile so that somebody could rent a unit from their mobile phone from anywhere in the world and then go and get into that unit because they have digital access codes. So doing all the things that the mom and pops weren't doing to make these things profitable by utilizing technology and really just kind of some basic marketing in many cases. Well, once those started to get a lot of the low-hanging fruit, the mom and pop facilities started getting purchased by the likes of ourselves. The big guys, they were still developing the REITs, the real estate investment trusts. But then they were also realizing that it was very profitable to go into these secondary markets and tertiary markets. And so they too were dipping down into and starting to play in our sandbox. And all the while consolidating as well. So there are a lot of the big facilities that the real estate investment trusts that were changing hands. They never made it to the market. There's only five real estate investment trusts, and these guys trade properties back and forth. So if they want to grow, they need to develop, and that takes a while, or they needed to look a little further down the road and outside of the major metropolitan statistical areas and start buying up these other facilities. So it's gotten competitive. There's been consolidation, like any industry that begins to mature. But there's also been a great opportunity for us to be able to provide the large deals to those folks as well. So we buy facilities, we add on additional square footage to get it to the size that is attractive to those folks, or develop them, or even get a shovel-ready development project in place and then present it to the market or present it to those folks to sell as well. So we've morphed and changed to looking more towards development and conversions of older buildings and retail buildings and big boxes. As the retail sector in this country has changed, my gosh, everything's going to Amazon and online. And there's big boxes all over the place. I mean, you can't swing a dead cat in a major city without running into a whole bunch of those buildings that we can buy and convert to self-storage. And so we've been doing that and producing those to the marketplace as well. So a long-winded answer to your question, but that's what we've been up to since 2005 and 2006 primarily. What
makes for a good self-storage location when you're going out and considering an investment? I mean, obviously you're looking at demographics, the income, but also you have to assess competition. How do you figure out where it's going to be successful? Because it seems to me that a lot of these are now clustering. It's in many cases it's becoming like CVS and Walgreens, where you'll get a public storage, and across the road or next door you'll get an extra space.
To answer your first question, what makes a good market? A whole lot of people and no competition around. How's that? That's a good market. But this is a science, and there are numbers, there are industry standards that we look to. It is not a simple business. It's not an easy business, but the business model is somewhat predictable in terms of, how we approach a market. And, we do a feasibility study. We hire consultants. Anytime that we're going into, if we're looking at a piece of vacant ground, a piece of dirt, 4 acres, 5 acres that we're looking to develop, or an industrial building, or, an empty big box retail that we're looking to convert to storage, we do some preliminary research, and then we hire a consultant to do a feasibility study. But what we're looking for, and what they're also verifying, is we're looking at the amount of square footage of self-storage in typically a 3-mile radius of this site that we're looking at. So we want to find out, who the competition is and the amount of square footage of self-storage within that 3-mile radius. Then we compare that to the population, the amount of people that are living in a 3-mile radius. This is a somewhat of a consumer product, cleverly disguised as real estate. And we know that about 1 in 10 households rents 1 or more self-storage rental units. And equilibrium in a given market, what we call that 3-mile radius, is somewhere around 6.5 to 7 square feet per person. So once we have that information, we gather that, we can see if there's 9 square foot of self-storage in that market per person. Well, it's, bordering on being oversupplied. If there's 3 square feet of self-storage per person, well, then the alarms go off when we begin negotiating on that building or that piece of dirt, and then looking to see if there's any other permits in the process of anybody putting a site in anywhere nearby. Now, that's one piece. The second piece to that is that there is a demand factor that we layer on top of that. There are many markets that we go into and we find that site that does have 9 square foot per person, 9 square feet of self-storage per person. We would, typically deem that to be oversupplied by 2.5 or 3 square foot per person. But when we visit the competition, they're all full. They're all at 95%, or they have waiting lists, and we scratch our heads and wonder why, until we find out that, well, there's no basements in this area. There's a whole lot of apartments, a higher percentage versus houses. The houses that are built are tract houses, single story, single family, only 2-car garages, sometimes less, no basements. It may be a military town, maybe college, it may be both, other factors that create a greater demand for self-storage. So, we back into the industry averages, we look at the competition, and then compare that all to the price of what it's going to cost to pay for that land or that building and then convert it or develop it into storage. And then we look at the rental rates in the market and model it out in a 5-year time frame, and with projections of what it's going to look like once it's stabilized. And then at that point, the numbers really don't lie. So there's a little bit of art to it, but it's more science, and it is somewhat predictable.
Scott, is there a rule of thumb ratio in terms of what you're willing to pay to either build or buy in relation to the square footage of rent?
Yeah, that's not really a rule of thumb. I mean, that only comes, Eric, after we model it out.
Okay.
So the higher rent in the market, and by the way, we like it when the big guys are in, the public storages and extra spaces, because they push rents. And so we like to come into those markets where the rents are a little bit higher. And so, yeah, it's really a function of going through that exercise, of the math, doing the projections and the underwriting to see where we end up. And so it's a lot of math, but at the end of the day, we need to go through that exercise to see if it'll work. We know, if there's 65 cents per square foot annual rent per square foot in a market, that we're not going to be able to build to cover that. When it's up at $1 or more per square foot is what the competitors are charging, then we feel pretty comfortable that we can build it, and it's going to be give us the profit margins we're looking for.
That's $1 per square foot per month, correct?
Per year.
Okay, I have to think about it while we're talking.
Talk to me about debt, Scott. What does the typical debt mortgage look like on these deals? I mean, are you getting non-recourse?
We like non-recourse when we can get it, like anybody else. That depends upon the borrower, obviously. But the asset class is really strong. Self-storage has the lowest loan default rate of any commercial real estate asset class, and by far. these things it's very rare that these things default, and they very rarely go back to the bank. And so for that reason, banks love these things. They love to portfolio them. The community banks, the credit unions, the savings and loans, the folks that do not bundle up loans and then sell them off to Wall Street or anybody else, they love self-storage because, as one of my bankers said, he said, you got to be a brain dead moron to make one of these things fail. He told me this after a closing one time. I said, well, I guess I'm taking that as a compliment, I think. But he says, go and get more. We love these things. So from that standpoint, we can find non-recourse debt on these just because, again, the lenders know that it's tough for these things to fail. And even if they did, it's usually a fault of the lender, the fault of the borrower and not the facility itself. But those traditional lenders, traditional lending, we're at 75, 80% LTV. Interest rates are, again, usually a little bit lower than the other asset classes just because of the nature of storage and because it performs better than anything else. And the SBA also has a very strong program that allows us to go up to 90% LTV, and they allow a 5% seller carryback on top of that. And that's this is the only asset class that the SBA will offer that loan package on, because they too realize that this is the only asset class that they can do that on because it profits so much.
Yeah, I didn't realize that the SBA, for the folks that don't know, the Small Business Administration will allow loans on real estate, but typically there are restrictions in terms of owner occupation of the space and percentage and whatnot. But so I didn't realize self-storage was an asset class that they actually allowed full bore lending without those owner occupied restrictions on it.
Yeah, they are. Wow. They are all in on self-storage, and the lion's share of all the loans that we do, and I'd say the lion's share of most of the loans on self-storage right now are going through the SBA.
Interesting.
They're big on self-storage, and we'll use those loans anytime we can.
Yeah, the insurance companies also like to fund self-storage and do them non-recourse.
Sure do.
One of the trends that we see is just the way self-storage itself has changed. It used to be, and you spoke about the land, whether it's 3 or 5 acres, but now we see them going vertical. And how does that change the investment equation?
Well, more expensive to go vertical in many cases, almost double per square foot. Just because of the nature and the style of construction. And then when you begin adding elevators inside, it increases the cost. But in areas, urban, especially infill locations or urban infill locations, it's very expensive to buy land. And so if you can go up, and if the rent, so once again, it all goes back to the rental rates. If the rent will support it, and once you model it out, then we're seeing a lot of these things built on 2 acres and going straight up. We got a few projects that we're working on right now, actually 3 that are multi-story that are going on less than 3 acres right now, which never thought we would be doing that, but they're in very strong markets with high rent and a high demand and high barriers to entry. So we're excited about getting all 3 of those off the ground.
So another piece of that I see changing is, you mentioned you want to find places without competition, which is hard to find. So sometimes you have to go a little bit more rural or out into the boondocks, and then people don't. Then you've got the cost of the managers and everything else. And now we see this technology coming up with remote gates and remote access, and everything's done by machines, kind of like going to an ATM. How's that technology working out?
And before I touch on that, you did mention that as well. And I think it was you, Eric, that said, hey, these things are going up. You see them like CVS's across from each other. I touched on the fact that, this is all about the supply index, meaning the amount of square footage per person in a market. So, indeed, if we see one facility that has gone up and you see another one going across the street, it just means that, the first facility wasn't built large enough, or because of its constraints in terms of the acreage that they had, they just weren't able to build enough to meet the needs, and they were full and had a waiting list. And so you see another competitor come in and do the same thing. We're not dumb, and certainly the developers on the high end aren't. So they know their numbers. They don't put them up and pray that they'll fill up. They do these the studies as well. And so sure, we'll see them across from each other. And quite honestly, there's a couple of folks out there, including the folks that we've worked with in the past, that they seek those out. They'll let the public storages and extra space, they'll do all the marketing in the area and drive them to their facility if they're full and they can't handle the customers that comes in due to their marketing. This new competitor will come in and take advantage of that. But in terms of the technology that's available and using kiosks, that's been a wonderful piece of technology that has allowed us to be able to reduce the manager's hours, which is this next to property taxes, the second highest line item expense in running a self-storage facility. And so if we can utilize this kiosk, which works, for lack of a better comparison, like renting a video at Redbox at the grocery store, you can go up and complete this low labor intensive transaction of renting a unit via the kiosk. And so if we take a facility that had somebody working 40 or 35 hours a week, and you can implement a kiosk and then reduce that to 20 to 25 hours, well, that adds up with the benefits and what have you. And the way that we value commercial real estate is based upon net operating income and applying a market cap rate. Well, then, pretty quickly we can not only capitalize that kiosk, but then it's gravy on top of that, and building back in, hundreds of thousands of dollars of value at a sale or a refinance on this facility by reducing those fees, those manager fees. But also, that now is almost old technology because of the advance of smartphones. The kiosk, the only thing that it does that a smartphone can't is dispense a lock. You can buy a lock through those kiosks, but everything else can be performed the exact same way on a smartphone. It just can't dispense a lock. Well, it's $18,000 to buy a kiosk and $250 a month to maintain it. Whereas a smartphone, well, obviously there's no investment in that. It's just, they connect via a responsive website. There's no monthly fee, and we just miss out on the sale of that lock. But we'll take that all day long. And we're seeing, last year the stats that I've seen were above 70% of all rentals at a self-storage facility, at the self-storage facilities that were polled, had rented their units from a smartphone. So we can see where the industry is going. We can see where society is going, and the technology that's available allows us to go in to these mom and pop facilities and reduce those managers' hours and increase the value.
How are you finding deals, Scott?
Well, I can't tell you that. You have an audience that's listening to this, right? No different than any other real estate asset class. We send mailers out.
Okay.
Buy a list of the self-storage property owners, in a zip code or within a county, hand-stamped, hand-addressed, number 10 envelope, looks like a letter from mom. Sometimes we highlight things here and there that says principal only, owner only, so that they don't get many times screened out by the gatekeepers. We use brokers, self-storage brokers, other commercial brokers. We use business brokers because many of these mom and pops list them with a business broker. And then, we canvass a market and we pull on doors. We're out in the market and talking to people. We network at the Self-Storage Association meetings to find out who's selling and who's not. You name it. It's a shotgun approach of finding deals. And I'm fortunate to be in the position that we've been doing this a number of years, that people know who we are and that we pay referral fees and partner and do joint ventures with folks. And so we get a lot of deals that are brought to us now. But in the beginning, it was all those other 5 or 6 areas that we focused on to bring deals into the pipeline.
Let me talk about another piece of landscape that's changing, which is the, it started off, it was all these concrete or metal structures going on for miles, and then we're going vertical. But also now there's these modular components coming up. How does that compare in cost and effectiveness? Actually, some of them are just single containers, but sometimes they're like a whole row of like 10 units in a row.
Yeah, so those are mobile storage units, not the same as like a pods. And by the way, pods are mobile storage. Pods is just the brand name, kind of like Kleenex is to tissue. Just a little education for all the folks out there. But we can put these modular units up and move them around the site, which is the original purpose of these structures and how the manufacturers had made them. And so what they were looking for is just places where we can put these, where maybe the developer made the drive aisle too large for people to swing around, or we do have an easement and a setback and we can't build on it, but we can certainly put portable units on it. But then we found that, because it's a portable unit, we don't pay property taxes on it because it's not an improvement as far as the assessor is concerned. And in most cases, not all, but in most cases, it is a lower cost per square foot to put a converted shipping container or a mobile storage unit. And there's different styles and flavors and construction types. But in many cases, it made sense because it cost less per square foot and we didn't have to pay property taxes. We pay personal property taxes on it, but we also get to depreciate these over 7 years instead of 27 and a half. And just overall, it was a benefit to use these. So many developers would build some buildings up front so that people would, see that and the nicer style construction. But then behind it, 90% of the rest of the facility was constructed out of these mobile units as well. So do they hold up well? Well, yeah, shipping containers will outlast any traditional steel built storage unit. Some of the other containers maybe not as long as a traditional construction with steel roofs, but they're getting better all the time and darn close to the same useful life.
And another point is maybe, you can tell me, but the permit requirements are not as stringent or maybe non-existent.
Yeah, they're not. I mean, certainly if you're going to build something, they want to know, and they meaning the municipality, the city, the town, and they may not grant that, but it may have zoning already in place for outdoor, for storage, which includes an outdoor unit, which includes, one of these units, a mobile unit. So you're absolutely right. In some cases, first of all, you don't have to jump through all the hoops, and second of all, the zoning may be in place before you even have to do anything or pay for a permit. You just may be able to plop them down as is.
Mm-hmm. Talk to us a little bit about cap rates, where they are right now. I mean, I know that's hard because it's probably different in Mobile, Alabama than it is in Miami, Florida, but can you kind of give us just a broad overview of where we are with the cap rates?
Like other asset classes, I guess most closely compared to apartments, there's A, B, and C classes of self-storage facilities. And that includes not only the facility itself. So take a Class C facility that's going to be in a rural area. It's going to be a tertiary market. It's going to be first generation, older properties that were built maybe in the 70s and 80s, not professionally run, may not have all the amenities like security and what have you. And so, yeah, depending upon the market, whether it's in Alabama, Mississippi, Florida, California, it's going to vary. But for the most part, they're going to command a higher cap rate or a higher return on investment because it's a little more difficult product. So, say 9.5%, it just really depends on, if there's any other issues there, but everything being equal, all things being equal, maybe around that 9% range. Class B, then, in between that and then the Class A, meaning the REITs, we're seeing rates sub 9, even down to 7.5, maybe 6.5 is pushing it for a Class B. And then Class A, the REITs, the big guys, and even some of the folks that aren't big guys, but a 55,000 square foot facility that's on a main road, that is multi-story, that is all temperature controlled, brand new construction with all the bells and whistles. We've seen those, when interest rates were at their lowest, we saw some of those trading at a sub 5 cap rate, so in the 4s. I think that's settled down now, and we still see those premier products in the 5 to 6% range for a Class A facility. But as you mentioned, it's going to change from market to market and from facility to facility, and just depending upon where we're at, and we'll start to see those creep up a little bit as interest rates go up a little bit higher. But right now, from what I've seen, unless any other report comes out recently, cap rates have stayed about the same, even with the most recent uptick in interest rates, so at least in self-storage.
In your opinion, is there still room in the market for an individual investor as a mom and pop to go in? Because the landscape's changed. I think like 60,000 square feet used to be a big facility. Now, they get economies of scale of 120,000 square feet or even 300,000 square feet. And so it's hard for the smaller facilities to compete because both of them still have to pay many of the same fees. Like you have to have a manager and you have to have,
let's talk about that a little bit because, the institutional guys, the self-storage REITs, they're probably just like the institutional guys on the apartment side that, they don't want to touch, let's say, institutional guys on apartment side don't want to touch anything less than 150 units. It's hard for them to make it economies of scale of that. So are you to just sort of, go a little bit deeper into Stephen's question, like what are he's asking if there's opportunities and where is that line drawn between mom and pop and institutional, and is that mom and pop area still a fertile ground for smaller investors to get involved?
Yeah, I'll answer that maybe a little different way than the way you're asking it, but that is, there's room to still profit in the mom and pop realm, if you will. So what is that line? Well, we see the REITs coming in, the national players coming in at, right around 55,000 square feet. So, like you mentioned, Eric, the big guys are looking at 150 units on the apartment side. We look at it more in terms of square footage, but that's our demarcation point for the most part. And so below that, you could call them regional players or very sophisticated mom and pops. How's that? So is there room on that end? Well, absolutely there is. I mean, there's still profit to be made on that end for, looking at any infill location. I mean, gosh, you're looking at almost any market, and you can find pockets and holes in areas that are undersupplied. As long as the rental rates are strong and you can build it, inexpensively and, mind your P's and Q's, absolutely. The reason why we're focusing, really on that 55,000 and above is just because of what I mentioned, the power of the cap rate. If we got these institutional folks that are willing to pay a 5% cap rate on something, then by God, that's what we're going to produce to the market, because it's more difficult to build a Class B facility in a Class B market with Class B rental rates for roughly the same construction cost. But then we're automatically giving up a point to a point and a half in terms of cap rate and returns. So we might as well find a little better site and build it a little bit bigger, and then produce it to the folks that are going to pay more for it in terms of a cap rate and a multiple. Does that make sense?
Yeah, absolutely. Yep. What do you figure per square footage that your construction costs run to build a storage facility these days?
Yeah, again, all across the board. Single story, traditional self-storage facility that you're used to seeing, steel buildings, steel roofs, $25, $30 a foot, include $25 a foot without the concrete pad, $30 a foot, including the concrete pad and the site work. And then if you add a few more of those amenities, it's going to be a little bit higher than that. But that's kind of the back of the napkin math that we do on that. When you start to go multi-story, however, it about doubles. And we're seeing some markets are even a little more expensive than others. But $50, $52, $58 a square foot for the multi-story facilities, because, again, it's costlier to go up. And then you begin adding elevators and a whole lot of other things that make it more expensive.
So, Scott, I just want to, we've been talking and I've been thinking about our conversation. I just want to revisit that question where we asked about the rent per square foot that you can expect. And, we were talking about $1 per square foot. Can you just go back and just explain that to me a little bit?
Yeah, probably the easiest way to put that is, most markets that we go into that we're looking at, and as we're talking about developing in a stronger market, is about $1 a square foot. And so what that ends up being is $12 per square foot per month, so $12 per square foot per year.
Okay.
Did I state that incorrectly last time?
Yeah, that's okay though. I mean, it's good that we clarified, because I was very confused. I was thinking, okay, if it's a 5x5 or $25 a year, it's like, man, I'm not sure. That sounds like a pretty bad investment to me.
Yeah, that wouldn't work. That wouldn't work. So I apologize. I must have misunderstood the question.
No, good. We clarified it. That's the important thing. So, Stephen, you had asked earlier about marketing also, and I'm curious on marketing and management. Scott, so what in the apartment world, apartments, you've got on the investment side, some of the investors are managing their own apartment complexes. Others are looking at it more from an asset management, where they might be, hiring an institutional manager to deal with their properties. How is that handled in the self-storage world?
Yeah, probably no different. The threshold is, well, let me go back to some more rules of thumb. So typically 10 hours per week is what is required of management hours per 100 units. So you get to a full-time manager when you've got 400 units or thereabouts, roughly. And, if it's a smaller facility, if a mom and pop where the investor is getting in and it's a smaller facility, it's going to be, tougher to make that work. It's going to be tougher to find somebody to be able to work a smaller amount of hours, because most people want to be closer to full time in order to do this, unless you can find a retired person to handle that. So that's another reason we're trying to, for so many reasons, buy as much, build as much as possible, at one particular site, because for so many reasons it makes more sense. The main thing being, how are you going to manage it? If you're going to buy 100 units or 50 units, it can be done, but you're going to have to do it yourself, or have a retired person who hangs a cell phone on their hip that is available, and then obviously rely heavily on a responsive website and mobile phones for them to be able to rent a unit from you. So we like to have the best of both worlds, which is 400 units or more. where we can have a manager there that's 30 to 35 hours a week, not only to rent units, but to, persuade those folks when they come into the store to, well, not persuade them, but make sure that their needs are met, making sure that they're getting exactly what they need, but then also promoting the ancillary products and the income streams that we can add to a self-storage facility, which is insurance, which is locks, boxes, moving supplies, you name it. There's a number of add-ons that we want to be able to maximize the value of that customer that comes in. And that doesn't happen with a kiosk, and that doesn't happen on the website. It only happens with a person that is there and negotiating with them, as well as making sure and fulfilling their needs, because that's how we maximize the performance and drive the NOI on these things is with the ancillary income streams.
The other thing that I've seen driving NOI is remarkable sophistication in self-storage management these days with the rental rates. I mean, they're getting people in and, they'll give a month free but then it starts escalating pretty rapidly and
it is. Yeah.
And there's all the little fees also, which are profit generators.
We have demand-sensitive pricing models, and the property management software companies have really gotten on board with this recently. And it's no different than the airlines. I mean, we're just following their model. Nobody knows how much everybody on that plane purchased a seat for, but pretty safe to say that just about everybody paid a different price. And so, that's all based upon supply and demand. So if you're in line at a self-storage facility and the person in front of you rents a 10 by 10 for $93, and all of a sudden you walk up there after he's done and the price goes to $99, you may be saying to the person, hey, behind the counter, hey, what are you doing? You just leased the one to that guy for $93 and you're charging me $99? How can the price go up that much? Well, it's supply and demand. If you don't like it, the person behind you will take it for $99. And if you decide to come back, it's going to be $108. And so you can't argue with that. That's kind of the way most of the rest of the world works. And self-storage is just applying that logic to their pricing models, and the property management software just calculates that for us.
Well, that's the other thing, is that on the storage side, that it tends to be less intensive from an absolute dollar number than it is on the apartment side. If you increased the rents on your apartment owners by 10%, they would be getting the pitchforks and torches to come drag you out of the management office. If you increase 10% on something that's only $75, it's $7.50. I mean, it's not nearly as noticed as it is on a $1,000 apartment unit.
Yeah, and also to Stephen, to your point as well, the fact that they can. A lot of these folks are folks, meaning like the REITs and other savvy owners. They're really minding those rates, and they're ratcheting them up as soon as they possibly can, because our leases, our rental agreements, are month to month, and so we can raise rent the next month if we wanted. Most of the models out there are 7% every 7 months or so. It's kind of an average, but in a case in which a facility is filling up really quick, they may be raising to their internal clients even quicker than that and more aggressively than that. But also to your point, Eric, as I've said all along, gosh, $5 increase in rent, they may be mad, but they're not mad enough to rent a truck and come down there with their mother-in-law on a Sunday and move their stuff out and go pay another $20 non-refundable admin fee at the competitor for roughly the same price. They just don't do it. But if you have a $5 rent increase across 400 units, multiplied times 12 at a 7 cap. You just gave yourself almost $100,000 raise every time that happens. So, we're very very on top of our rental rates and very aware of what we can and can't do. And if we lose a couple people, that no big deal. They were leaving anyways.
Sure.
If they're leaving because we raised the rent for $5, that's just a parting shot on their way out the door. They were heading out anyways, and who cares? Let them go. We'll backfill that one with somebody paying the new street rate.
It's kind of the way I feel about Steve and I. Raised the rent on his office, and if he leaves, I don't really care.
That's right. Good luck with that one.
Hey, Scott. So tell me, you guys, if there's somebody out there listening in the audience that might be able to help you, what would that person look like? What would they be bringing to the table for you? Is it coaching? Is it deals? Is it financing? What are you looking for?
Yeah, we got two businesses. We have an education business, as I mentioned at the top of our show, and an investment business. And I'm moving more towards the investment business, and our education business is kind of feeding that. And so, right now we've got a lot of private equity partners. We don't have all the money that we need to do deals, but we're really looking to do more deals. And so that can be development, that can be existing. So just strong deals. And when I say deals, I mean, we don't take leads. There's lots of people that'll, send leads into us. They'll go out to LoopNet and say, "Hey, Scott, heard you on a podcast and found this deal on LoopNet."
Yes,
send
thanks.
It over. Hey,
Thanks.
Analyze this and make a deal out of it. Negotiate it, finance it, run it, and then give me 50% of the profits. So
sounds like a great
We're
partner.
not looking for that.
Yeah.
We're looking for savvy folks that want to work with us. We're looking for savvy folks that want to learn the business. We'll teach them how to do it and partner with them. We're also looking for folks that are advanced that want to mastermind with us. That's a function of what we do. We have this underground community of folks that we're out to take the world by storm. Total self-storage world domination is the ultimate goal, and I'm personally moving more towards just working with advanced people to put them all in a room where we can share deals and share the equity that we've raised and just put deals together and without the rest of the world seeing it.
Awesome. Stephen, anything else before we let Scott go?
Scott, I enjoyed it. It's such a relevant topic, and sounds like you're doing an awesome job. So thank you for being with us today.
Yeah. Is there anything else that you'd like to add before we let you go, Scott?
If you're interested in learning more, head over to our website. We got some free resources and tools and our live events to teach about how we go about this business. And also, if you're interested in working with us on partnering and JVing, same place, selfstorageinvesting.com.
There you go, selfstorageinvesting.com. Scott, appreciate so much the time that you spent with us today, and looking forward to hopefully working with you here in the future.
Fantastic. Thanks, Eric. Thanks, Steve. Appreciate it.
And that was Scott Meyers talking self-storage. Steve, it has been a while since we had somebody do an update on self-storage for us. Scott, extraordinarily experienced guy, has his act together. It was really enlightening for me to be caught up on what's happening in the market, and certainly appreciate Scott coming on and spending some time with us. What were your thoughts?
It was so interesting to see that REITs are still getting stronger all the time, but there's still room for individual operators. What was fascinating to me is the predictability. Self-storage was once a strange kind of investment, but now it's a consumer need, and you can predict the demand by the surrounding population.
Yeah. I mean, it really is quite remarkable. They'll keep their things and keep packing them away. And I guess that's human nature to store it. And they're living in smaller and smaller spaces, which creates more and more demand for self-storage. So again, that's an awesome sauce that we had Scott come on and tell us what was happening. Just like Scott, we've had other great speakers on the show. Stephen, where can folks find those?
Best place in the universe, investfloridashow.com. We have a whole library of podcasts, guests on fascinating lectures, and you should listen to them not only on the computer, but when you're mobile or you're in the gym. You can download the app and listen on your phone.
And guys, we wanted to remind you folks in the greater Tampa Bay area, we do have a meetup. If you go to meetup.com and look for the Invest Florida Show investment group, check us out. We've got regular meetings there, and we'd love to see you if you have an opportunity to come by. We've got folks that come as far away from Orlando and from Brooksville and down into Sarasota will come up and meet with us and some of our guests. So love to have you come and check us out, come and meet us at the office and listen to some of our guest speakers. So, guys, as always, we do appreciate the time that you invest with us each and every episode. Until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Steven Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida Show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.